All right, part two of our federal withholdings, module 5. We're actually going to now determine how much money should we take out of our employees' checks for federal withholding purposes, because it's not always the same. It depends on your marital status, and it depends on dependents that you have. And there are a few other things, but those are the two biggies. Whenever you start a new job, you have to fill out a W-4. Now, if you've started a new job since 2020, as of 2020 or beyond, then you would have filled out this newer W-4. It's totally revamped. Anybody before 2020 would have filled out the old-fashioned version where you put down allowances and based on if you work and if you have kids. Well, it's not quite the same anymore. We're going to see how it's different. Now, if you were at the same company, you don't have to file a new W-4. You can if you want to, just because it's new. There are guidelines for your HR department to follow to say, okay, you can still use the old W-4, and then here's what you do. But any new employees are going to fill out this new W-4. All right, so you still got to know your filing status, and we're going to basically pick one of these. They could have put it into 5 different ones like they do for tax purposes, but they just combined these two, single and married filing separate, because they're taxed pretty much the same. Married filing joint or qualifying widow, both of those are taxed about the same. And then head of household would be the third one. You no longer have to determine how many allowances you're going to claim. That's what you would have done in the past on the old W-4. You come down with step 2. You're basically going to check this box if you and your spouse both work and both make about the same amount of money. Now, when I say about, I'm saying probably within about a $10,000 range. It's not specific. It doesn't state that, but that's what I would probably recommend as a guideline. So if you're within about 10,000, you can check this box and you'll see how that comes into play in just a minute. Then coming down to your dependents, you're going to figure out how many kids do I have that are under the age of 17 that are my dependents. And then I'm going to put in an amount here, 2,000, 4,000, 6,000 if I have 3 kids or more. Okay. And this is for most people whose income are below these high thresholds. And then any other dependents that you claim, parents, anybody else, kids that are over this age, you can put 500 a piece for them. And then we're going to add up the total over here. And you'll see what we do once we have that. And then step 4, if you're getting extra money from other places and they're not getting taken out appropriately, you can have your current employer take more money out of your paycheck. That's what you're going to do down here in 4C. You're going to put on here, I want $25 extra taken out of my paycheck every pay, or $10 because maybe you're paid weekly, so you don't need as much taken out. That's what you're going to do. And then down here, if you happen to meet the criteria that you're not going to have to file and basically you're under the standard deduction. Here's the standard deductions for 2021. For those that are single, if your total earned income is going to be this amount or less, you can write exempt down here and you won't have any federal taxes taken out. Now, the bad thing is then don't expect very much money, if at all, to come back when you file your taxes, if you do it all. Or if you're married and you expect to make less than $25,100 in income, total your AGI, then you can write exempt and you won't have any taxes taken out. That, if you do that, if you write exempt, that's something you have to reclaim every year, and you do that by February 15th. All right, so how we actually calculate, once we've got some of this filled out, this is, we'll come back to this in a second. We're going to come to our publication 2021, the publication 15T for use in 2021. Make sure yours says 2021. If you use the one that's attached in this module, it will say that. If you can actually go and look up online and just Google publication 15T, just make sure you specify 2021. Now we're going to come over here and there's lots of different sections. We're going to come here to this page 51 and then come down just slightly to page 52. And these are the charts we're going to begin to use. And it's going to be one of four. It's going to be depending on how you're paid. So the first one's weekly, then it's bi-weekly, then it's semi-monthly for the next one, and then monthly for the fourth one. And those are the four primary ways of being paid. Okay, so we're going to use this along with our W-4. And a lot of times it's easiest if I just go through one, and that's what we're going to do here. And then you'll kind of see how it works out. Okay. So again, with step 2, you're really only going to check box C if you married and both of you work with similar wages. All right, let's go through an example. And I'm going to pull up the answers and we'll go through this kind of slow so you can get the hang of it. All right. So some of the items that we've got here, the first thing we've got to get is on the correct chart. So we're on the weekly chart and this says it's bi-weekly. So we need to come down to the second one. we're single. So we're going to find over here, find the single one. And then it says nothing about us having a second job, because that's one of the items that you could check that extra box. If you have single and a couple more jobs, you're going to do things a little differently. We're never going to have that. If we're single, we're just going to have one job. So we're always going to be on this side on the left if we're single, because this is if that step 2 box is not checked. We're going to use this side if the step 2 box is checked. And that's typically for us, it's only going to be if they're married and the spouse has a similar income. All right, so our next thing we're going to do, we're going to be down here in the single, 3,000 taxable. So they could have gross income of maybe 3,500, but that doesn't matter. We look at the taxable amount, 3,000. That's going to bring us right here. $3,000. What we're going to do is using this, we're going to work backwards. I'm going to bring over the answers. We're going to take 3,000 and the first step, we're going to subtract the amount that we're over this amount, the very far right. So 3,000 minus the 2041. And then whatever the amount that we're over that is, we multiply it by what's considered our marginal rate. That's a term we're going to get to in just a little bit, but we'll say it early. We'll use the correct terms. This is our marginal rate, 22%. Okay, and then we do that calculation. So this is about $950 times 22%, 210. The last step that we do while using this chart is we take that amount and then we add in this set number. So we're going to take 210 plus 179, and that's the amount without any other items that are given to us, like they need extra money taken out or they have kids or dependents. It doesn't tell us any of that. So this is the amount that would be taken out of this individual's paycheck on a bi-weekly basis. Kind of high. Out of 3,000, this would be well over 10%. And you can see annually what it comes out to be. He's going to have $10,000 taken out for federal income taxes. Again, this is somebody single and no kids, so they have the most. All right, let's look at our second example, adding in a new item. Okay, so we're going to just practice using different charts. That's nothing big. We got somebody that's head of household, so that means they have a dependent. $2,100 taxable federal withholdings, taxable for federal withholdings. They get paid this much. That doesn't really matter. This is the important part. And then part 3, we go back to the W-4. Part 3 is your dependents. And it says they have a total of 4,000. So most likely they probably have 2 kids under the age of 17. All right, so what do we do in that situation? Okay, so we go down, come to our semi-monthly pay period. Head of household, so that's the bottom one. $2,100. We are not checking box 2. We're not married. So we're automatically going to be over here for head of household. $2,100, that's going to put us on this line. Right now we can start figuring up some of the tax. So 2,100 minus 1,375. So that's the amount we're over. The amount, we take whatever that is times 12%. 12% is our marginal rate. And we get $87. We take the 87 that we just got and add in the set amount, the 59.20. That's going to be our starting point for how much federal taxes we get taken out. But we still have one more thing that we have to calculate, and that's this. When you have something in part 3, what you do is you take that 4,000 and you divide it by the number of pays in a year for that individual. This one's semi-monthly, so that's twice a month. That means there's 24 pays. So we're going to take 4,000, the amount that it's given in part 3, and divide it by the number of pays. The number that we get, we can subtract from this amount. So what that's going to do is actually put us below 0. So this individual, based on how much they make, knowing that they're going to get child tax credit, potentially some earned income credit, although they're on the high side, they may not qualify for that. Without looking at the actual tables, I wouldn't be able to know. I wouldn't be able to tell you the earned income credit exact, but it would be pretty small if they did. This individual wouldn't, it's by the calculation here, wouldn't owe anything. Now, if they want a little bit extra back or just to be safe, they could tell their employer to take out some extra money on their on the 4C and say, hey, go ahead and take out an extra 15 bucks. Or maybe they only put 2,000 here. You don't have to put the full amount. And so that's up to you. So this person, the way it is, would not have any taxes taken out. Because that number would go below 0. And so what that's telling me is based on their child credit, they would actually get some money back on their, when they file their 1040 as a refund, as part of the refundable tax credit. All right, let's take a look at this last example and see what happens here. We've got weekly pay, and this time we're going to include a spouse. Spouse earns about $27,000. The taxpayer that we're working with makes about $59,000. So they're not similar in pay. So we still would not check that box 2 in step 2. We're going to have to do something else. We're going to have to come do the 10. We're going to see how this works. But at the very bottom of the W4, all the way down here, we're going to use this table right here for a section. So we'll have that ready to go as well. But to start off, we have to be on here. It says we are weekly pay, so we want to get to the right table. We are married. The wages are not the same, so we're going to use this side over here. Our federal withholdings, or our taxable wages, are 1,150, so that's going to put us right here. And with that, we can begin the calculations. So 1,150 minus what we're over, this amount here, the 865. Multiply that by our marginal rate, 12%. So we get $34.20. Add that to the set amount, $38.20. So our starting point is $72.40. Now we come down to the next box and we see that, okay, we have part 3. We have 4,500 there. So how we would typically get 4,500 would probably be this guy has 2 kids under the age of 17. So he'd have 4,000, and then maybe 1 kid, maybe in college, or that's 18, 17, and have a 500 here. So a total of 4,500. Okay, so our next step would be, all right, we're going to take 4,500. And remember, you take that amount that's in box 3 and divide it by the number of pays in the year. This is a weekly pay, so 52 pays. So we've got $86. Now, if we were to stop right there, this individual would not have any taxes taken out. But this individual is going to have extra money coming in because the spouse also has money coming in. So the higher your income total, the higher taxes you pay overall on your 1040. So they want to take that into effect when you're having taxes taken out. You want to make sure you don't owe, because nobody likes to owe at the end of the year. So they're going to take that into effect. And that's where we come down when we have a spouse who works, but they don't make the same amount, whether it's higher or lower. So it says, okay, take your higher paying job, whoever's the higher paying. And in this case, it's the actual taxpayer. They're almost at 60, but not quite. So we're going to use this line right here, the 50 to 59. And then we're going to use the lower paying spouse, and they're right here. It says they make 27,000. So we're going to use this amount, and it's kind of hard to see, but $3,080. Make it a little bit bigger. 50,000, and then come over to the 20 to 29, and we're at the 3,080. So what we're going to do is we're going to take that 3,080, divide it by the number of pays. And this we're actually going to add back in as additional tax. So we take our starting amount minus the dependent part plus our spouse's extra income. And when you add and subtract all of those figures, this is how much the individual should have taken out of their paycheck every pay. 4,509. Just one extra factor about withholdings. When you have retirement money coming in, remember, retirement money isn't taxed up front. You get to take that off and it's not taxable. Well, when you take it back out, it is taxed. And what they do, you have something similar to a W-4, but for retirement money, they call it a W-4P, that you can ask to have one of these filled out. If you don't fill it out, they're going to use a standard married with 3 allowances. Most companies do. They're going to use that as the default. They don't have to, but that's a lot of times the default. And so they could take out, or they could take out less, especially if you're single with no kids, no dependents. They could take out less than you actually need them to. So it's always good to fill out before you start taking money out of retirement account, to fill out their W-4P for retirement. So we talked about marginal rate. The marginal rate was the actual highest tax bracket that you're in. That's what a marginal rate is. So whenever you hear somebody saying, I'm in the 12% tax bracket, or I'm in the highest tax bracket, which for this year is 37%, that number goes up and down depending on administrations, presidents. They can highly affect this number. Back in the 60s and I think 70s, it was really, really high. Reagan came in and began to bring it down, but it was up in like the 60, 70 percentile, even higher than that. It was really high. And then it started coming down, and it's been coming down. So because basically what was happening, when you get tax rates that high, even up to 90%, those people who make that much money, they have enough money then to go find CPAs, others that can find ways and loopholes. So the government actually doesn't get the money that they think they're going to be getting. They would actually get more if they just had a lower percentage. And so those highly paid individuals, it's not really worth their time and effort to find all these back loopholes and go through offshore accounts that the government found that they make more money if they have a lower tax rate. You think, well, so that's kind of a weird thinking, but it does work out. All right, so this is your marginal tax rate, your highest tax rate that you pay into. So let me briefly explain how this works. if I say I'm in the 12% bracket, and so we're in the weekly, and I make, let's say $1,000, like on one of our examples, I make $1,000. All of the 1,000 that I make is not taxed at 12%. Only the amount that was above 865 is taxed at 1,000. The first 483 that I make isn't taxed at all. Then the dollars of 483 up to 865, that next set that they give me is taxed at 10%. And then the last little bit that I made is what's taxed at 12%. So I'm taxed a little bit at each different rate. And then, so what that comes out to be is, what is my average rate? This is the highest rate that I'm in, but most of my money isn't taxed at that rate. It's actually, most of it's taxed at the lower rates. So I wanted us to calculate. So what we do is, all we do is take what is our taxable income and then divide it by the actual amount of tax that we paid. That gives us our average rate. So what I want us to do is, what is the marginal rate and average rate for the above practice examples? Okay, so if we go down here, hold on one second, be right back. All right, so with this example, remember our marginal rate was 22%. Our average tax rate, all we're going to do is take the amount of tax that we had, the 390, and divide it by our taxable income, which was 3,000. So we're paying, even though our marginal rate is 22%, it's a good thing we're not paying all of our tax at that rate, because we're really only paying 13%. And that would be our answer down here for 13%. Now, what you should do is go up and do the other two examples, and then we're going to see what you get if it's answered. So go ahead and pause and do that right now. All right, our other two examples, these are what you should have got. So on the second one, the guy didn't pay any tax. So his average rate was 0, even though he's in the 12% rate, because he has those kids. The kids bring down the amount of tax. And then finally, the 12%, but the average is very, very low, just under 4%. All right, we're going to finish out. We've got two examples to make sure we've got this all understood, ready to go. So lecture example number 4, we've got our single individual. I give us our gross salary. So you're going to have to determine the federal taxable salary. It's paid semi-monthly, only one job. Note what she has for step 3. And these are some of the deductions she has. So what I want you to determine is how much taxes should we take out of the paycheck, her marginal rate, and what is her average tax rate. So go ahead and pause now for lecture example number 4. All right, so we're going to have the semi-monthly pulled up over here. Individual is single, so we're going to be in the middle column. We earn a gross salary of 3,000, but that's not what we're going to use. So that's our gross. So we're going to take 3,000 and we're going to subtract out those items that are not taxable. And medical premiums, the 150, not taxed. The 100 in charity donations to United Way, that's still taxed, so we can't take that away. The 200 in 401k, yep, that's not taxed for federal income, so we can take that out. I remember for FICA, it is still taxable, so we don't take it out. But for federal, we do. So we're at 2650. That's going to be our starting point. 2650 is our taxable income. So we're going to start at 2650, figure out where that falls. And we're going to take 2650 minus the 2211. Whatever that comes out to be, take that times our marginal rate. So that's already the second question answered, 22%. That leaves us at 96.58. We add in the set amount here, 194.26. And we're left with our starting federal withholdings of $290.84. But that doesn't take into effect the 3,000 we have, or the 2,000 we have for step 3. So it looks like we probably have one kid under the age of 17. So we're going to take that 2,000 and divide it by the number of pays that we'll have for the year. So if we're semi-monthly, it'll be 24 pays. So we're going to take 2,000 and divide it by 24 pays. So this is the amount that we're going to subtract from our federal withholdings. So 290 minus the 83. This is what we should have had and what would be deducted or taken out of the employee's check for their federal withholdings. 207.51. All right, for our final example, and then you have an extra practice to do as well, and it kind of goes back all the way to week 1, where I give you in the practice, it gives you an opening trial balance, and then you pay your opening taxes, and then you use your payroll register that you already have made, and we're going to use the updated one. And on those, you would want to calculate your federal withholdings, these items, all of these steps here. You'd want to do that in Excel, and you would list out each individual's name, like where we do for the Social Security caps. So just below the total columns, you'll put say employee A, and then you'll have these cell references to show the work and to come up with the amount. So then when I'm grading it, I can see how you got the amount and give you partial points if you happen to miss something. All right, so our last thing here, what we're going to do is kind of do and you could do this in your payroll register, or you could just do it here. It's maybe just as easy. Go ahead and try to do it here. It also helps remember how to calculate your federal taxable pay. So I want you to, Jessica was single, we got paid biweekly. I give you all the information that you need. And then I want you to, it says journalize this pay, including all required employer expenses. And then journalize all these taxes, because I don't give us any opening amount. So we're going to pay them afterwards. You always pay them afterwards, but I don't give us any starting amounts either to pay ahead of time. So go ahead and pause, and then we're going to go through all the answers on what we would do for lecture example number 5. Okay, the answers for lecture example number 5. First off, we need to calculate what is our taxable pay for FICA purposes. I got it to be $1,200. We take the $1,450 starting out, and we can subtract $150 taken out for medical premiums, and we can subtract out $100 for the dependent flexible childcare. Can't take out the $100 for 401k. The employer puts in additional money. That's great, but it doesn't affect our tax purposes. It'll affect the employer's journal entries coming up, and they put money into the 401k. Great, but it doesn't affect our pay. So our FICA is $1,200. The only difference between FICA and federal would be the extra $100 taken out for a 401k. So this actually goes down to $1,100. The lower that gets, the better, the lower tax you're going to pay. So now we can start filling out our payroll, all these amounts here. But I guess what I'm going to do next here is figure out what is our actual tax for federal withholdings. So I'm going to do the calculation. We are paid biweekly. So we need to come up with the biweekly. Single. So we're going to be over here. All right, we were at 1,100. So that's going to put us again in the 12% bracket. So 1,100 minus the 865. It's being parentheses because you have to do that first. Times that difference by 12%. add in the extra $38. The only other item it gives us is it says there was $2,500 listed on step 3. So that's our kid, it's our dependents. So we can subtract that out once we divide it evenly by the number of weeks. So it's bi-weekly, so that means there are 26 weeks in the year. So we're going to take 2,500 divided by 26. So $96. We take 66 minus the 96, so that leaves us with a negative. So no money taken out for federal withholdings. And then the rest of these, I took 1,200. We're nowhere near the cap with this income. 1,200 times 6.2%, 1,200 times 1.45%. And then the other items that are taken out of our paycheck. Here's our net pay. With that, we can now make the journal entry. This being our wage expense, and then all the items that are taken out that go to some payable account. And then finally, what the employee is paid. It says this is the third pay of the year. All right, so that's going to make a difference that would normally make a difference for feud and SUTA. I'm going to change that up. We're going to actually make this, let's make this like the 20th pay. It doesn't matter what number it is, except that it's going to be a high number. So therefore our feud and SUTA are already capped, because I don't really want to get into feud and SUTA until we get to that week in the chapter, or that week in the module. So module 7. So we're going to, with the 20th pay, and remember you always use your federal. So if we took 1,100 times 20 prior pay, 20 prior pays, that puts us well over the caps. So no feud and SUTA tax. The final 2 journal entries for this pay period, and we separate them out. We separate out how much the employer pays in addition. They have to pay $200 into the medical insurance premiums. So we call that a medical insurance expense. It's just like a regular expense because it's money coming out of their pocket. And it shows that we need to add 200 to that bill that we owe to, let's say it's Blue Shield, Blue Cross. And then they pay in $100 to the 401k. That's an extra 400 out of their pocket. And we need to add that onto the bill for, let's say it's TIAA CREF. Our final amount says journalize the payment of the 941 taxes. Remember, those are federal withholdings and FICA. So we would add up all of our Social Security and Medicares and our federal withholdings. Well, we didn't have any federal withholdings, it was 0, but we would have added that in here if this person would have had it. So this would have been what we owed, because when you add 7440 plus 7440, I got this. You pay that off, you pay this off, and you write a check for the 183.60. All right, to end, I wanted to show you what your practice will look like. The practice, here we go. So I give you the 2 employees, I give you all of the opening balances in this very small little trial balance. And so you're going to make your initial payment for your Social Security, Medicare, and federal payables. This is the 6th payday as of March 31. We're going to make a payment though on March 20th for all of the bills that we owe, and then do all of our normal stuff. And then when you are filling out your payroll register for this one, that's what I would do. This is what I mean by doing the federal income tax. So down below, and somewhere where you can find room, don't get rid of your 941 form, because we're going to be using that in the next week. But find a spot where you can show your work, or you don't even have to do this. You can just do the steps and what the formulas would be. So this is like step one, where we take the federal, where we take the federal taxable wages. So I-2 right here. I can't even make the cell bigger. Well, it's locked. Take I-2, this number, and subtract out. It would be 1,700 minus the 1046. That's what's going on in my little cell. So this is it. This is what I have. And this is what's actually going on, written out the long way. This is an Excel format. So this is all of the calculations and then the final amount. And this 160 would end up here. 52 ends up here. So you can follow along to see if you did it right and what I did. And then you can do the same thing. Again, you can show all the steps if you want and this, or you can just do this. And either way is acceptable to me. All right, that will conclude our for module 5. And next week, we're going to look at state and county taxes. We're going to put all together into our Form 941. And we're also going to look at something called the fair tax. And what does that mean? With that, I will see everybody in our module 6.